Right.
All right, it's a little after 6 o'clock Thursday, May 23rd, 2013. I'd like to call this meeting of the Audit Committee to order. Who starts?
Yes, sir. Bow our heads. Lord, we thank you for everything that we have that most of the time we don't deserve, but yet you provide for us. We thank you for family and friends. We ask that you guide us during the holiday season, anybody that's traveling. We thank you for the beautiful city of Floresville and all its potential and glory. In your name we pray. Amen.
Committee members present are myself, Jim Miller, Councilman Eric Rodriguez, Councilman John Guerrero, citizen members, Mr. Doug Jones, Mr. Edward Conley, our city manager, and ad hoc member, Ms. Faye. You can stand for the pledge. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Honor the Texas flag. I pledge allegiance to thee, Texas, one state, under God, one and indivisible.
Lacking any other attendance, I assume there's no citizens' input. With that, I'm going to go ahead and turn it over to Ms. Flagger and her presentation.
Thank you. I appreciate again the opportunity to present this report. As we had discussed earlier, some of you weren't here, this report says draft on it. We were still getting the MD&A finalized. I was late delivering some schedules on the MD&A, so Laura had to really hustle to get that done. We were still making refinements and changes in the middle of last week, and frankly, I couldn't get it through proof and through page numbering for this meeting tonight. I don't expect that you'll see any number changes. The final, I've got it into printing as we speak, and I'm hoping to have it out next week. So that is my plan, and I apologize. I feel like I told Laura I've been living with this report for 5 months, so I'm real ready to get this off of my desk too. I'd like to kind of go through how this is organized a little bit and talk to you about what I perceive are some highlights. If you all have any questions, feel free to jump in anytime. On page number 1 is the independent auditor's report. The city did get another clean or unqualified opinion on the report, and I'll talk to you as we go through this, the reasons for that. As auditors, we must put the reader of the financial statements on notice if we feel like you won't be in business within a 12-month period from the last year end. I guess one advantage of living in support for so long is you've got 4 months till the next year end, so there's no issues there, even though the general fund is showing a deficit in its fund balance. We all can agree that you'll be here. So we do have a clean opinion in that regard. Clean opinion means that these financials or statements are stated fairly in all material respects in accordance with government accounting standards. Following that, through page 3 through 9, is the management discussion and analysis. This was written by the city. We provide the financial statements, and they provide this discussion of some of the high points. The topics discussed here are must topics. We can't vary from these topics that are in this management discussion and analysis. So I'm not going to go into this in a great deal of detail. It's kind of an executive summary of the government-wide. And as the discussion goes on, I think you'll have a better feel for what these members mean in this part of the M&A, as we call it. just about, 12 years ago, governments are required to present their financial statements with two different perspectives. The first perspective starts on page 10, and this shows all the assets of the governmental entity and all the liabilities. It's an amalgamation of everything that this city is, including its component units on the right. I think these statements, these are the new statements that were required 12 years ago. I think the reason for these are it helps rating agencies compare cities or other types of entities to one another. For example, you'll see that we have capital assets on the asset side. We show your infrastructure there. That infrastructure are things like streets, bridges, roads, that kind of stuff. And we're required to depreciate that in accordance with, I'm going to call it GASB 34, that was the change. Now, an interesting thing in this perspective, I don't think personally that this tells the whole picture of a city, because you can't go out and sell a bridge and make money on it in order to augment your operations. I think all this does is show the level of your infrastructure and the amount of debt against it. So going down further, this statement shows under non-current liabilities the total bonded debt and capital capital leases. So then we get down into that bottom section, which is net assets. It's nothing other than assets minus liabilities. It would be your net worth, individually speaking. It would be your retained earnings if you are more familiar with business type presentations. But in that net worth, most of these assets are tied up in infrastructure, property, plant, and equipment, your buildings, your land, and that's what that $6,357,000 is. That's what's tied up in non-liquid assets net of the debt. So we also have restricted assets. We can't, net assets, we can't spend that $217,000 on anything. It's got to be spent on debt service. We have capital projects of $156,000, that's restricted. We have some special revenue funds. So your unrestricted net assets on this broad perspective are $201,000. Now, I'm not sure I'm going to go into any depth on the statement on page 12. GASB in its infinite wisdom, and that, by the way, stands for Government Accounting Standards Board. It's the standard setter for all governments. Made this the most confusing schedule on the planet in that it starts with expenses. And then we have charges for services, and then down at the bottom we have your general revenues like property taxes, sales tax, and so forth. Instead, I think there are some other perspectives that are actually better understood that I'm going to get into a little more. Turning to page 14. This is the other perspective. I mentioned that we have the two perspectives, the full accrual, and this is the other perspective. This one is more like a cash basis presentation. It tells you what do you have that's available to be spent, what assets are available to be spent, and what are your liabilities against those assets, and what's the net, how much net worth do you have under that perspective. So we're not looking at land, we're not looking at debt, we're not looking at all that stuff that really doesn't come under your governance control, really. So your assets in this case for the general fund, and I'm going to concentrate on the general fund because you don't have a whole lot of governance regarding the debt service fund. It is what it is. You collect the taxes and pay the debt. The other governmental funds are special revenue funds and your capital projects funds. You don't have flexibility on those, so that's why I'm concentrating on that first column. So we have total assets of $512,000. We actually had a deficit in cash. That is, we had checks written against our cash account at the end of the year that we hadn't sent out yet. So we don't really have any cash on our books. We do have some receivables for property taxes, $185,000. And that's probably going to trickle in over time because that's all years this entity has been collecting taxes. Under other receivables, we have sales tax receivable, totals $263. Sales tax makes up $219,000. Your hotel occupancy tax makes up $24,000 receivable. I'll go into sales tax receivable in a minute because we had a prior period adjustment. The city changed the way it recognizes its sales tax to an acceptable method of recognizing sales tax. We didn't do it last year because we're conservative. We don't recognize revenue if we feel like historically you would not, but I'll get into that in a minute. So under liabilities, you see the bank overdraft was $224,000. We have accounts payable also outstanding at the end of the year of $184,000. And you can kind of march on down here and see where we are. That leaves us with a deficit in the general fund of $244,660. Debt service has cash, but again, you have to spend that on debt service. And your other governmental funds, the special revenue funds and capital projects have $223,000 in fund balance. Now that next page shows you, page 15, just a reconciliation between the two methods. If you want to, I'll go into it in greater detail, but I think we can hit on some more germane statements. Page number 16. This is your income statement, if you will, showing again all your funds across the top, and again, concentrating on the general fund. Your revenues were $3,034,000. That is roughly the same as it was last year in 2011. Your expenditures totaled $33,827,000. Now that includes a debt principal payment of $212,000. Again, this is perspective. All it cares is about where did the cash go. So we're telling you that the cash went out for debt, principal and interest. It's this schedule. So we had a net loss before transfers of $973,000. I thought about going back and helping you compare to last year and this kind of stuff, but last year you were accounting for things in the general fund that didn't really belong there. It was not a violation of law, but you were running your debt service through here, you were running other things through the general fund. Plus you had some community center expenses in 2011, you didn't have in 2012. So it's difficult to compare those expenses between years, so it is what it is this year. Now we did have transfers in of $449,000, and in a minute I'll show you the footnotes. You can see what made up those transfers. You all issued a capital lease for a piece of construction equipment. That gets to be called another resource. So your net change in fund balance was the $303,000 negative. Now, we're getting into the prior period adjustment that I agree with, Laura proposed. What has happened in the past, you collect obviously 12 months worth of sales tax. Well, the sales taxes that are collected, they're always 60 days in arrears. So Christmas sales, you don't get that tax until February. So what governments can do, because you can measure it, is that we can say, okay, we're going to shift the 12 months to equal when those people paid that sales tax. And you can do that. You see what I mean? Is that making sense? So your sales tax collected are for the months of November 1st of the prior year to October 31st. You see, I'm just shifting months on you here. I have to give this a little bit of thought myself.
It's projected.
No, it's actual. We know what those numbers are because the comptroller was. Now, the reason that Laura convinced me that I think this is appropriate to do is that your sales tax collections are improving. You know, they were in the toilet back in 2011. And by shifting that 12 months to the proper 12 months, it actually improved your prior year fund balance to the extent of 224, that's not quite right, $180,000. And including that 224,000 with another prior period adjustment that we had, TIF had convinced us, the Riverbend TIF, that we were not holding cash for them. That $44,000 has been sitting on your books forever, and I wasn't going to write it off. I'm conservative. It's not my job to help you find more revenue to recognize. But we confirmed with TIF that the city does not owe them that $44,000. So we brought that in as, it would have been property tax revenue, as I said. And then you need to go, so it hits your fund balance.
Oh, it's a transfer.
Probably
for
something.
years of.
I thought they didn't even know what was going on.
Oh, no.
And they've got, a couple of guys
Yeah.
seem to be really sharp.
Because when we first started out, they said, well, we haven't had a meeting, we don't know what's going on.
No, that's, the people that are doing the taxes are, yes.
Two different pieces there.
Yes.
There, two different pieces. The accounting piece is because it's property tax dollars is done is through the firm and through the city. The issue you're talking about is more of a management issue.
Right.
Okay, and from
That's
two
it.
different perspectives.
Yeah.
So the fund balance that I presented to you at the Board of Council meeting last year was a negative 166. That has been restated to a positive 58,421.
Now,
Any-
I have a concern. At some point, we're missing some money that got counted. If we're gonna shift our timeframe forward 2 months, to which one we're gonna do this, we lose 2 months in the back, and then that
Well-
previous year gets shifted, and this really can be a domino effect going back.
This is really the right way to
This
do
is the
it.
first funded deal.
And we're
Won't
not
happen like
losing
this
any
again.
money because we're calling it, I mean, you're gonna get the money every month.
Well, I'm not concerned about losing money or that, but if we're talking about a 12-month period of sales tax, okay, okay, now we're gonna account for it when it's accrued, that's fine. I'm okay with that. But in the previous year, we hadn't done that, or the previous years, we hadn't done it. It had been on, for lack of a better term, a cash basis. So by making that shift forward 2 months, not only are we doing a prior period adjustment that's gonna help us this year, it affects the previous year, and the year before that, and the year before that. And
You're right, but it does end up being essentially a cumulative effect because everything gets closed out to net assets. That 180,000 really is essentially that accumulated effect of all that shifting. But you're right, those financials in prior years, if sales tax either went way up or way down, they're gonna be off somewhat on those prior years. You know,
And I understand why we're doing it now, okay? But it seems to be more of a, let's do that now so we can make up this, and yeah, it's gonna do fine future, but unless we come
Should have
back.
been done several years ago.
If we're correcting stuff like we're
Please
supposed
let
to be
me finish.
correcting, that's one of the things that we're looking at.
Please let me finish, okay? That if we're making that adjustment now so that we can reduce this deficit piece. Pardon me?
That's not what that was for.
Please let, well, this is how it's being explained to me, okay? And, you know, I may not be an accountant, and I may not be a city manager, but I am the chairman of this committee, and I am an elected official, and I want to understand this. And my perspective says if we're gonna shift the accounting by 2 months, and we're going to, of this money, okay? Are we doing that accounting for all other types of income? Or are we just doing it for this type of income? 1. 2, how does this impact our previous financial statements? Okay, if we are making this shift now for this fiscal year, what impact or what changes are we gonna have to go back to previous financial statements? And if that period is this 12 months, okay, but the previous financial statements were based on a different 12 months, okay, there's a gap between them, okay? If it was, just for convenience sake, let's say January to December was the previous accounting period, now all of a sudden we're gonna go February, or March 1st to February 28th, okay? When did those 2 months, well, we shifted them back to the previous year. Well, then what about the other 2 months at the beginning of that? It would appear, okay, to be a shuffle piece to me. I'm more concerned about what this does, you know, if we're gonna make this change, okay, are we doing it uniformly to revenues? Are we gonna begin accounting for revenues based upon when they are accrued, not when they are paid. And what does this do to the previous financial statement?
Let me start with the first comment. How do we treat other revenues? The Government Accounting Standard Board is very specific about when you must recognize revenue. If it's what they call a non-exchange transaction, in other words, I'm charging you tax, I'm charging you sales tax, and you're not getting any hard anything in exchange for it. I'm not selling you something. So that's a non-exchange transaction. You must recognize that when it's measurable first and available second. And available means available within 60 days of year end, which is why that sales tax really should have been accrued back all those times ago. If it is an exchange transaction, like, for example, we're charging a fee, we're going to go out and do an inspection for you, then you recognize that money on an accrual basis. And go out and get it. Property taxes, you have to recognize on a measurable and available basis, which is generally when you receive the cash for property taxes. So that was your first question. So we don't have a choice on when we get to recognize revenue, period. The second thing is, you are correct. Had we presented 2011 with this proper recognition of revenue, where sales tax revenues would have been $180,000 more, and your fund balance would have been, plus with the TIF, that $58,000 that we're talking about. And you're right, prior financial statements, maybe it wouldn't have been significant, but because sales taxes is going up, it happens to become more significant.
Do we need to now amend?
It's not typical because we beat it to death, and I'll show you here, we have a lot more disclosures to talk about in this year's report.
That clearly identify how this change would have changed previous years
That's
before.
why it's called a prior period.
I'll show you some footnotes that'll
Thank
hopefully
you.
help you.
Does that mean then you go back into the last audit and remove the insolvent comment?
Well, last audit, I didn't have an insolvent comment. So this one, we were gonna talk about it. Last year, I think last time we talked about the deficit and fund balance. But had we done that accounting differently, you're right, you wouldn't have had a deficit fund balance. You would have been in not great shape. I mean, 58,000 is still not where you need to be. Ready to move on, Richard?
Thank
Thank
you.
you. Page number 18. These are your business type funds. We account for them separately outside of the general fund because these are exchange type transactions. The water, wastewater and sewer, let's just go on down to the unrestricted net assets in each of these, which is the third line up. Water and sewer had unrestricted net assets of $305,938. You can read across. Refuse was $108,000, cemetery was $61,000, for a total of $475,000. Now on the next page, we have a cash.
Excuse me,
I'm
I'm
sorry.
not following you where you're at. We're on page
Third-
18.
Yes, sir. Third line up
Assets.
from the bottom.
Oh.
And what that is, Jim, it's your assets minus liabilities, taking out the net assets, the investment in the wastewater plant and in the water treatment facilities. So that's really what assets are available to be, net assets available to be spent. On page 19, I'm going to direct your attention to the fourth line down. And what that is the cash provided by operating activities for each of your types of business entities. So we had generated $107,000, and obviously you can read over, $9,748 in refuse, cemetery $6,000, for a total of $123,000. Now these revenues are uniformly down from last year. You look, for example, at 2011, and water and wastewater generated $448,000 roughly. I think it's probably, if anything, a function of the weather. We have to talk about the water and the other utility rates later. I don't know if those rates were changed in 2012 to incorrect amounts, or we need to kind of talk about why that is. I think the biggest thing is probably the weather.
Yeah, the rates have been the same in the system for years.
For years and years, so it wasn't the
It's-
rates.
No, it was winter, from what I can see. An increase in customers, too, I believe.
Oh.
So
bunch of different things. Could I move on to the footnotes, please? Page 31. At the top of the page, it shows you where your cash is. And this is all cash. Includes all of your business type activities, it includes debt service, it includes capital projects. So you had $723,000 in the bank, a small amount in Texas class. Most of it was in a Fidelity money market, and then we had bank deposits. And again, this is cash for all entities. You know, we talked about the general fund having a negative cash, but the other entities had cash, so this is a citywide perspective here. Would you turn to page 33? At the top of that page are transfers among funds. And I mentioned I was going to show you where that 440 some odd thousand that came into the general fund came from the unemployment fund. And I'm going to talk about that in a minute. It came from the street maintenance in order to cover your street costs. And it came from the enterprise fund. It came from, well, I can show you that. It came from water and wastewater. Is this a good time to talk about the unemployment fund? Maybe so. In the past, and again, you all, a lot of you were with me last year you all were with me struggling through with what are these funds and what is this cash? And I think we've had conversations about, we've got this pot of cash in the bank and nobody knows what it was used for. And I think a lot of that was, we've had a lot of turnover. And something that made sense to a prior administration, we wouldn't, didn't want to write it off as auditors because, who knows what's going to pop out when we finally realize what this stuff is. You all do not pay unemployment tax to the state. Instead, you are billed, if someone claims unemployment on the city, you get the bill for that. Pardon me. So what a prior administration did is they set up a fund that says, okay, we're going to not pay as you go, we're going to drop some money in there, and then when these claims come in, we're going to pay it out of there. Well, that hasn't happened for years. And so we had this $52,977 sitting in a bank account, it's real cash, that it didn't belong there. And councils are inclined to do that. They're inclined to set up separate pots of money. And then when council changes, administrative changes, we lose track of what it was for. And that's, I think, what we were faced with last year. I don't know if y'all saw that long list of bank accounts, but we had about 20 or 30 of them open. So that's what that is. So we moved it into the general fund. We're not going to do that anymore. Turn please to page 36. This shows you the debt obligations for the future, just for the governmental funds. And so you can see we had a total debt outstanding of $8,839,000, which is mostly the 2008 series, which you had a refunding, you had a small tax note. And so those are the obligations in the future. We're required to list 5 years individually, and then we're required to show 5 years lumped together. In note number H, we're talking about the fund balance deficit. Now, you all know you can refinance your debt, and you're going to have to.
Yeah.
Yeah, and that's not a bad thing. It's just something that has to be done. And the reason I think you did the 2008 refunding is that you could accomplish a little longer tail on that debt. Well, in exchange for that, you had some big payments due in some of the later years. And I talked last year to the financial advisor. He said, I know, we got to redo that debt. It was just something that made sense at the time. So, that, we know about that. The fund balance deficit. We had talked about things like going concern. If you're not going to be in business for 12 months, we have a lot of things as auditors we have to disclose, which could include, at the most serious, is showing your financial statements on a liquidation basis, which means what can we get for this at an auction tomorrow? which makes your balance sheet go into the tank. I feel like, after we know that the general fund has problems, we know the general fund is insolvent. I think you're gonna be in business another 12 months. You all have put your heads together and put together a plan. I'm not sure that we're moving as quickly as I would like to see on that plan. But I did want to mention to the readers that you're going to adopt a zero-based budget. You're gonna monitor the activity. You're gonna add a 30% per year deficit reduction and a 90-day reserve by 2018 and 19. So I think it's just a matter of a lot of hard work in the next months and years to come. Let's see, page 40. This is, on the top, a discussion of the prior period adjustment. We showed that TIF money being transferred into the general fund, and then the accrual of sales taxes to the correct period presented, and that's for each of the funds. We're consistent. We're gonna run those same changes through 4A, and 4B already approved there, so we were okay there. So that's where those numbers came from.
So we have not done it for 4A in this?
Oh, yeah, we have. We're consistent across the board. 4B, since they did their own books, they always have it.
Right.
Yeah. 43, please. This shows you the other side of the coin from debt. We have all these debt payments that we are required to pay. However, we have interlocal agreements with the 4A and the 4B to pay bonded debt as well as capital leases. So this shows you what those 4A and 4B entities are required to pay. 4A, that first column should have bonds. This is why, one of the reasons this is a draft. The second column should have capital leases. That's why they're in two separate columns. And it shows you what those entities are obligated to pay you in the same format as we have in debt. And in PVC, of course, as well. So when you refinance your debt, I'm sure you'll have different interlocal agreements. And that happened when you refinanced it back in 2008 as well. I think for EDC is going to be okay. I think that 4A obviously is going to be struggling with that in 2016. Page number 45.
Why is EDC in such better shape?
They didn't have as much.
There was that the 4B got 5 million and the 4A got 5 million.
No, ma'am. Of the 8.5 million, 5.5 went to the 4A.
Okay.
1.5 went to the 4B. 1 million and some change was retained by the city, and that was the sewer plant for phase 1 upgrade. So of the debt, 5.5 million was the 4A, 1.5 million was the 4B.
It's just the numbers one.
No, yeah, that's perfect. I'm glad to help if I can. Page number 45. This is your budget to actual for the general fund for the year. The reason that we have a negative variance in property taxes is that when you all had budgeted, you budgeted your debt service fund as well as your general operating funds. So we had to move that money out into the debt service fund. Your sales taxes, I'm not sure, were you all budgeting for that in the general, the street maintenance tax probably in the general fund? Remember, we moved that to a separate.
And EDC portion that went to, yeah, it was leveled, yes.
Yeah, when we budget the money that goes to EDC and 4B, that's not our revenue. So we need to be sure when we're budgeting, we leave it off in here.
And it is this year.
Okay. Likewise, what you did is then you had an offsetting expense for it. You know, and for audit purposes, we just netted those two and went forward. Moving down, we had a negative variance in the administration of $403,000. And I think we all know that that was the professional and legal fees, mainly professional and legal fees. Down in streets, you didn't pursue some projects that you had originally budgeted to pursue. in that portion of the city rate retained of the 4A 2008 bond issue, y'all should probably start budgeting for that debt service. You hadn't budgeted for that in the past, and that is a general fund obligation.
What debt service is this?
It's the 2008A, and it was used to police cars and.
Okay, I know what that is.
Yeah, and it has to be paid out of M&O.
Right.
So, this pretty much mirrors the rest of it, what we showed back on the income statement for the general fund. If y'all don't have any questions, I would like to just go ahead and turn on back to page 55. Do you recall last year, we had a letter that we had, in addition to the report, we had a separate letter outlining what we perceived as this material weaknesses and significant deficiencies. We still have a few, not as many as we had in the prior year. Let's see, last year, 5. This year, I think we got 4. I'd like to talk first of all briefly about the deficit and fund balance. That is a technical violation of law, and the budget, the difference was unbudgeted and unexpectedly no professional fees. I think that just kind of says it. We'll move on. Laura Fegan, when she was reviewing the utility rate ordinance, it found that the ordinance wasn't what we had in our utility billing system. And it would have been very difficult for us to go back and quantify what that difference would have meant to the city. In general, I think, Laura, you found that they were underbilling customers. Now, I think you all have recently implemented new utility rates, is that right? So, and y'all have tested that system?
It hasn't been entered into their law. They don't go into effect.
Okay, I see.
Can't put them prior.
Gotcha.
So once this next billing goes out, then
We'll go through and test that against the ordinance and run enough what-ifs, you know, different kinds of customers, different levels of usage of water, and just see to that we've got that thing nailed.
Well, and clearly, you know, when we received our water and sewer rate study, the city's gonna need to be facing probably a 3-phase increase in water and utility rates. The first phase was just to cover the operating deficit that was going on there. The second phase to support some expansion needs of it, and then ultimately a third phase to maintain that and do that. That was a good presentation and a good study, and you know we have a couple other pieces ongoing that are going to have some impact on that. But that was we waited for that rate study so that it was more than, so that we just did not implement the adjustment there. We knew we were going to have to do a greater adjustment. The water rate study was due any minute at that time, so it got delayed, and that's why.
Yeah.
But that is being implemented.
That makes sense. A lot of my cities charge impact fees to new
We're
construction. Are y'all gonna do that?
we're on the track for that. One of the things that's happened, and I think just a little bit of time on this, because I think it shows how well in the right direction that the city is going. We currently have a land use plan going on that's going to address many things like where is the growth going in the city so that we can plan infrastructure appropriately, as well as zoning ordinances, et cetera. At the same time we're doing that, we have to be able to know where our infrastructure is and what its capacity is, so that if we have to expand on that capacity, what is going to be the impact? Well, in order to do that, okay, we have to have the appropriate mapping and the appropriate models in place to do that. And we've initiated that so that, as well as the software purchases, so that these are electronic, and the software piece is going to enable us to maintain these maps internally, whereas today it's one paper map. Okay, where our staff can do the updates and do much of the calculations involved in there, so that if we have a new service our staff will be able to determine, do we have the capacity to do that, and reduce some of our significant professional fees, which right now is an outsourced service. It will also do some other things, you know, the most current electronic city boundaries at the state level, from the state comptroller's office to the Texas Department of Public Safety, you know, are hand-drawn maps. We don't have a formal electronic boundary that everybody can recognize, and this software will do that. And all of that is going to lead to our ability to have the correct, but we've got to know what we have and what its capabilities are before we begin to look at what is the actual cost to add to it. And that process has started. It may be a 3-year process, but it is moving forward. And at some point in the future, all of these things will be in place that are going to reduce, ultimately, overhead costs to the general fund and professional fees and other services, and ensure the appropriate revenues from sales tax, and et cetera.
Yeah, because these people buying into the infrastructure, and you already got it, you need to pay some kind of a fee. So that's good, that makes sense. One caution is that some cities haven't been tracking their impact fees correctly and end up having to send it back to the developer because they have to spend it within a given period of time. So just a word of advice there, be in that position. Payroll matters, it's over on page 56. You all aren't using your payroll module correctly. In fact, you're really not using it to even close to its full potential. In other words, tracking of your compensatory time, vacation, and sick is being done on a spreadsheet. And it's not always consistently applied to all of your employees. The balances can be and should be maintained in the system. And it makes it consistent. The machine knows how much to add in vacation to the pay period. You can get reports out so that the employee knows what his pay stub, how much he's got. The managers know how much is out there for these employees. They can manage your employees' time a whole lot better if we use that system the way it's been done.
Can I ask the obvious question, why are we not doing that? Lauren?
County staff prior to me was unaware how to utilize it and been working on that.
And correct me if I'm wrong, but right now we don't have someone that is capable of doing that, or that is full-time doing that.
Sure.
We don't have a human resources.
We don't have an HR person, we've got a payroll clerk, or a clerk that takes on the payroll duties. And this payroll matter was brought up by Laura and presented to auditors to say this needs to be stated in here because it's something that we were working on. She is taking the lead on that she will train the payroll clerk to do that on the computer system. So
That's the next obvious question. If we don't have somebody on staff who's capable of doing it, what does it take to get somebody on staff capable to do it or train somebody to do it? And that's obviously got to be a priority if it's going to be listed here.
And it is, and it has been, and it started with Laura, and she has taken the individual and started working with her on it. It's one of her projects, and she's got a little easel, a little board in there, dry erase board, that she's written everything that she wants to accomplish in the near future.
I have a question, I'm going to go backwards. For unemployment, how's that stand now?
You still are pay as you go?
There you go. Is it?
How was that money being put in there?
It's not, it's silly to have a separate.
But previously, how was it put?
Oh, I don't know, to tell you the truth. I hadn't seen anything go into that fund.
Yeah, that,
How
that's
far
been
did
there,
it
I
go
believe,
back?
I went back 4 years,
I thought
5
you
years.
just said that.
So it just went stagnant, money was put in there, and then went stale?
I think it was in
Interestingly enough,
preparation.
Oh, okay.
Let's keep it so that everybody's on the same conversation
Getting
instead
all
of.
ugly and nasty
Yeah, the comment was
business.
that you thought that perhaps everyone was required to pay unemployment. Governments can opt out.
Is that typical of municipalities to opt out of that?
Yeah, it's really more expensive for y'all to be in the system than it is out. You know, and you need to work on your, if you get someone claiming against you, you need to fight back
Say it
as
loud.
you can, so.
Right, because if they're getting released or if they, you know, leave on their own.
Right.
And, yeah, that's the, I've seen both, I've seen cities have it where they have a lot of turnover and it can be cumbersome, but it's, if you get APR side right, typically we have very low claims. Since I've been here, we have a $204 payment. It was related to someone who was in the pool, and it wasn't that he was let go, he was eligible just because of the season and being over. So, $204.
Okay.
50, yeah. So,
Now, hand in hand with the payroll issue is the insurance deductions. The system that we're charging the employee and paying to the insurer, we're not reconciling that. And I'm pretty much convinced, and Laura, I think, is convinced as well, that we're not recording the deductions properly necessarily, and we're not reconciling that insurance bill to be sure that it's accurate. You know, one more place that we can just be
That's
sure.
our self-insurance portion of that, right? Or deductible reimbursement.
Health insurance.
It's
The
both
health
sides.
insurance bill.
The system was not, it's been set up now since, I guess, a fixed portion of it in December, but there were several sides to it. The city's portion that in place for employers was not on the payroll module. You can set that up to say this is how much the city pays, and it expenses it for you during payroll, and it hits the line items. That piece had never been set up for every single employee. It was only if someone had dependent coverage. So when the bill was coming,
Okay.
it was that piece. Then the employee's portion that they might have to pay for dependent coverage has not always been maintained properly as well. So it caused not always, if someone leaves in the middle of a pay period, excuse me, in the middle of like a month, because you're on a 26 pay period, you're not always collecting the full piece that they owe for, say, if they had child coverage or family or whatever their dependent share is. So it causes actually having it on 26 pay periods, which is how it was set up in the payroll module. It makes it very nasty for reconciliation when it comes to people leaving and just in general, because your billing doesn't match what you're expensing each month that's hitting AP, because it automatically hits the accounts payable.
Is that
So-
because the billing is monthly and the payroll is
Yeah,
bi-weekly?
and I've seen this at City of Pearland, similar situation, and it was causing huge problems, and they just went to 24, so there's 2 months out of the year that people don't have insurance. If they have insurance deducted, it's just not deducted.
I mean, 2 pay periods, not 2
There's
months.
two pay periods.
Okay.
So.
That adjustment's being implemented?
That's what this comment is about, and we want to do that on open enrollment, which would start October 1st, to give employees some time to, there's only a handful, we're not talking $300 change in paychecks, we're talking 20, 30. So,
Let me ask you a question about Phil's second. Someone told me, I think Melissa told me, she says, there's a certain amount of time that over a period of time that the hotel, I'm gonna talk about hotel more.
Okay.
They're in the room a certain amount of months,
Days.
and then the hotel motel tax stops. And the city doesn't receive any more of that.
Right, because it's not considered like a hotel, it's considered more like a.
What is that time limit?
Do you know what that time?
30 days.
Oh, is it?
I believe it's 30 days.
It's 15 days, I believe it's a 15-day continuous.
And then we don't get any hotel.
Well, and if we look at the hotel motel tax, and there's a piece of legislation pending on there was on the hotel motel tax, and got kicked back on that to eliminate that exemption, but obviously didn't make it through. But what it does for the consumer is, hey, I'm renting the facility just like I would rent an apartment because I'm staying there for an extended period of time. Therefore, the hotel motel tax should not apply. As that relates to the revenue that the city has seen, I don't think it has had that kind of a big of an impact. And maybe it did at the very first piece of this when we had a limited number of hotels. But when we look at the competition between hotels there and the revenue now, we're getting the hotel motel tax that was projected. I don't think we're losing money because of that.
Yeah, the new hotels that came in we never realized it because they didn't exist before, so it's, yeah.
Good, check.
The legislation has changed.
The next comment, and this is non-material, I mean, these last two that we talked about, it's important to bring to your attention and should be dealt with, but it's not as serious as a material weakness is the municipal court. It uses the same software that the accounting software that the city uses for its accounting software. And it's connected to a separate server, so it doesn't talk to the accounting software at all. And I think that we need to connect the court to our system to get that, our internal controls over the court, municipal court. Because currently, not say there's anything wrong or any theft going on, but she is pretty much autonomous on how she handles the court. And she appears to be slow in making her bank deposits. I looked at January, I think it was, don't hold me to that, I think she made like 4 bank deposits, and some of them were fair size. So the whole system, if we were to bring it into the city system, I think we would achieve timely deposits. We'd achieve some reconciliation between her docket and what's being deposited, just some controls over that municipal court system.
I will add to that, I also understand that the EDC portion of this is looking at working with the city so that the EDC is using the same type of reporting system so that it all comes together, and that makes perfect good sense. The big question is, what are the costs in doing that, and what is it going to take to implement that? And the recommendation is very much appreciated, and I think mirrors the direction that the city is going as a whole, is to bring all the books to look together.
Yeah.
The court's very, we already have the cash receipt